Hey there, and welcome back to the Icelandic Investor channel. Now, I've taken a break of about 2.5 years in putting out videos. Just because I was tired of making videos, I was doing about two per week. Also, I think I was just making videos about stuff that I wasn't really interested in. So, my thought is to come back now and start making videos because I'm very actively investing in the markets. I would say, almost every day reading something related to the markets, reading annual reports, reading write-ups about companies and all that stuff. So I do think I have a lot to share with you guys that could benefit you in your investment journey. So my plan is to make videos about the companies that I'm investing in and give you an update on their 10Qs and their 10Ks and kind of follow their progress. I might also throw in some videos about what the super investors are doing with the 13 Fs, and maybe some review videos about the investment content we find on YouTube and Twitter to try to help you guys find the best content out there. Now, I won't be making videos about as many companies as I did before, because I've been mostly focusing on high quality compounders that I have on my watch list or that I'm actively investing in at the moment. These videos are going to be focused on more in-depth analysis, and I'm going to try to cut out most of the B-roll and that extra fluff stuff. It's mostly going to be content for hardcore value investors and people trying to learn the trade. So I'm not saying that I'm some kind of super investor that has decades of experience in the markets. I've only been investing for about 5 years or so. So it works more as an investment journal for me, which I'm sharing with you guys, getting the feedback and showing you guys what I'm learning and hopefully getting better. So I'm going to spare you a longer introduction and talk about what I'm going to be discussing in this video. So I'm going to be going over my current portfolio, not really digging in too deep, but just showing you guys what companies I have in my portfolio. And then maybe I'll do a deeper dive on each of the companies in later videos. So let's dig right in. What I use to track my companies is that I use Guru Focus. You can create your portfolio there. And you can put in all the metrics that you think are important to track the intrinsic value of the company. As you can see right here, I use free cash flow growth rate per share to try to gauge how much the company is growing their intrinsic value. I use a 1 year free cash flow growth rate per share, 3 year and 5 year. Now I also have enterprise value to free cash flow and price to free cash flow, which is kind of a simple method to see how the business is valued. I don't really look at PE because I think free cash flow is a much better way of evaluating a company. And then I have return on invested capital, return on capital employed, and return on equity, which are super important. And I'm trying to create a portfolio of about, I would say, the optimal number would be 15 to 20 companies. Maybe I could go all the way down to 10, maybe up to 25, but I do think 25 is a little bit too much. And I think the 10 companies is probably not diversified enough. So what I've been doing is I've been diversifying more, trying to buy great compounders, trying to buy companies with lower market cap, because I've been buying, Meta, Alibaba, companies like that, which can be a good bargain, but I mean, they're huge companies. How much are they really going to grow? If you buy Apple today, which is a $3 trillion company, is it going to go to 9 trillion? I don't know, but it's much harder for Apple to grow than a company that has a market cap of 1 billion. So if you go over the companies that I have in my current portfolio, only 9 companies at the moment, but I'm trying to make it hopefully 20. We'll see how that goes. The smallest company that I have in my portfolio at the moment is called Gravity Corporation, which is a gaming company from South Korea. They do only have one really successful IP, which I believe came out in 2002, which is called Ragnarök Online. They've been shifting more to mobile. They do have, like we can see, they do have really strong growth in free cash. You can see the 3 year free cash flow growth rate 53%, the 5 year 29%, and the return on invested capital is really high. I think this is an error though. The return on invested capital is probably not 293%. That sounds a little bit too much. But they have really good return on capital employed and return on equity. and they're just really cheap. You can see that the market cap is 447 million, their enterprise value is 126 million. Since they don't have any debt, they're holding over $300 million in cash. So you're buying the whole company for 440 million. You're getting over 300 million cash, no debt, and I believe they're doing around 100 million in free cash. So in my opinion, this is some kind of mixture of buying a quality company at deep value Ben Graham prices. But the thing is, like I said, they don't really have any moat. So I think the market is kind of suspicious on them being able to continue to make money off of that single IP. But that's what they've been doing since 2002. And I read through all the write-ups at the Value Investors Club, and it's always the same bear thesis. It's always that the IP must be dying out, but then the company just keeps on growing. It kind of went ahead of itself in the 2021 bull market, where I think the market cap went to 1.2 billion and was trading around, I think, 30 times free cash or something like that, which was obviously an overvaluation. If we scroll through their fundamentals, this company actually seems to have decent fundamentals, which is a little bit crazy compared to their price. But it's a small company and it's owned about 54% by Gung Ho, which is the parent company, so the shares aren't really that liquid. So let's move on to the next company in my portfolio, which is called CarGuru, which is basically a site that sells used cars online. And I bought this company almost 3 years ago, 2.5 years, maybe, something like that. And what has happened that the intrinsic value of the company keeps growing, but the stock price has been really volatile. At one time it went over 50 bucks. I probably should have sold then, but hindsight is 2020. If you look at just the fundamentals of the company, you can see that they have a really healthy growth in their free cash. They are cheap. So their enterprise value to free cash is only 7 times. So for those of you who don't know what enterprise value means, it just means the market cap of the company. You add in all the long-term and the short-term debt, and then you deduct the cash. And ideally, you want to have a lower enterprise value than market cap. Most of my companies have a lower enterprise value than market cap. It's just because I don't like investing in companies with a lot of debt, and I do prefer that they have a lot of cash on hand just to be safe. But looking at CarGuru, we can see that the return on invested capital is not that high. It's actually going lower. Same with the return on capital employed. But the return on equity is good. But the company has been having some problems with a company that they bought, I believe it was last year, called CarOffer. So they have had some problems implementing the CarOffer operations into CarGurus. And initially when they bought CarOffer, the price of the stock shot up. But then management ran into some troubles regarding operations and the stock has been rather low since then. But I've been able to average down 2 times, so I do like the price that I'm holding the stock at the moment. So moving on to the next company, which is called Games Workshop Group. It's a really high quality compounder. It's a company from the UK that sells the Warhammer miniatures, which doesn't sound like an exciting business, but it really is an exciting business once you dig into it. And the company is much more high quality than I would have thought at the beginning. So let's check out the fundamentals of the company. And of course, when I do deeper dives into each of these companies, we're not just going to be looking at numbers, we're going to do the qualitative stuff as well, which in my opinion is an even bigger factor than just looking at numbers. So I just want to do a quick overview to introduce the companies that I have in my portfolio. So as we can see, Games Workshop has been increasing their intrinsic value by a lot for the last couple of years. For the last year, 84%, 27% for the last 3 years, and 25% for the last 5 years. The company is, in my opinion, cheap at the moment, less than 20 times enterprise value to free cash, which I think is an undervaluation for a quality compounder like a Games Workshop. The return on invested capital is super high, with the median being about 65%, return on capital employed about 66%, and return on equity 56% now or for the last 12 months, and 59% for the last 5 years. Now, they are still a relatively small company at only $4 billion market cap. So I would say I'm pretty optimistic about the future of Games Workshop. So moving on to the next company, which is called Evolution Gaming, which is from Sweden. Evolution is a market-leading company in the B2B space when it comes to live casino and RNG, and the company has really been crushing it when it comes to operations. Now, the biggest risk with a company like Evolution Gaming is always going to be regulation. Now, the company is trying to get a bigger market share in the US, which is a really tough place to compete, especially when it comes to gambling. But if you just take a look at the fundamentals of the company, they are super strong. You can see really strong free cash flow growth here. And the company is, in my opinion, relatively cheap at 22 times EV to free cash. They have strong return on invested capital, return on capital employed, and return on equity. Their operating margins are very high, and it's hard to see them sustain those operating margins, especially when it comes to extra cost of building out live casinos in the US and in other places. So lower margins in the future, along with tougher regulations, is probably one of the strongest bear thesis against the company at the moment. Okay, so let's move on to the next company, which is Fortinet. This is probably a company that you might be more familiar with than the rest of the portfolio. This is, in my opinion, one of the best companies in the cybersecurity space. I know you have Palo Alto and you have CrowdStrike and Zscaler and all these companies, but I just think that Fortinet is a better quality company than their competitors, to be honest. The company has a market cap of 45 billion, which I do think is relatively big, but on the other hand, the industry is growing, and I do believe the company has a lot of growth ahead of them in the future. It's similar with Fortinet, like Games Workshop, Gravity, and Evolution Gaming, is that they've been growing their free cash flow per share at a ridiculously high growth rate. You can see the average for the last 5 years, 28%, which is really high. Now, that's something you want to see when you look at the fundamentals of your portfolio companies. Regardless of the price action or what's going on in the stock market, this is fundamental investing. As it turns out, they're also trading at a low multiple, only 20 times enterprise value to free cash. Now, they do trade at a PE of 43, and in my opinion, Fortinet is not a company you can really evaluate on a PE basis. That's because they have a lot of deferred revenue, which is cash they've already received. So that gets counted into the free cash flow, but doesn't get counted as earnings until they deliver the services. So when you're evaluating a company like Fortinet, it's much better to use free cash flow. And we can see here that it's the same theme with Fortinet, like the rest of the companies: high return on invested capital, high return on capital employed. It says here that they have negative equity, but, well, they actually do, but that's because of the deferred revenue. You gotta put that on the liability side. And deferred revenue isn't a liability per se, but it does reduce your shareholders' equity. That's why they appear to have negative shareholders' equity. They've only just recently had a drop in their share price, which I took advantage of and started a position in the company, which I don't regret when going over the fundamentals of the company and looking at the bull and bear case for the company. So the next company in the portfolio is Alibaba, which I do think most of you recognize. I bought the company in May of 2021, I believe, which in hindsight was a mistake. So I made a couple of mistakes when buying Alibaba. First of all, I paid way too much for the company, and second of all, when I was watching the company, when I already had a stake in the company, I was watching how it was going. I really didn't notice that the company was actually becoming a worse company. So what I mean by that is that the fundamentals of the company were actually going down while I was a shareholder. They actually started to go down before that. And I would say the third mistake that I made with Alibaba is I was focusing too much on the price. The price kept going down. I kept buying more stock, and my allocation percentage-wise for Alibaba was way too high compared to the size of the total portfolio. Now I have been slowly reducing my stake in Alibaba when I've seen some better opportunities come along. I do plan to hold Alibaba because, in my opinion, it is still undervalued. So, what do I mean by Alibaba becoming a worse company over time? Well, um, you can see that the free cash flow growth of the company is only 8 and 6% for the 3 and 5 years. They are really cheap. Their enterprise value to free cash is only 6, but the return on invested capital, like you can see, is really low. Same with the return on capital employed and also return on equity. Both the gross margin and the operating margin of the company has been going down, which is something that we don't want to see for a company that you own in your portfolio. A company has a lot of cash, but the problem with Alibaba, which is a problem with a lot of the companies that I see in Asia, for example, in South Korea, like Gravity and some Japanese company, it is that they do like to hold a lot of cash, but they don't do anything with the cash. And it's really bad for investors if you just hold on to the cash and don't give anything back, either by paying a dividend, buying back shares, or acquiring new companies. So I would say my original thesis on Alibaba was wrong. I thought I was buying a wonderful company at a fair price, but now I'm really buying a fair company at a wonderful price. So the next company in my portfolio, Adobe, probably needs no introduction to you guys. Even if you're not in the investing world, you probably know Adobe Photoshop and Adobe Reader. Really not much to talk about there. I saw an opportunity to buy when the Figma acquisition was announced, and then later when the stock started tanking. Now, don't get me wrong, I do believe that the company overpaid for Figma, and I don't think their moat is as strong as it was, seeing that they had to pay $20 billion for Figma. But I mean, this company has great fundamentals, and I do believe that they are kind of a monopoly in what they do. So I'm happy to hold the shares. If you do a quick glance of their fundamentals, 3-year free cash flow growth rate 24%, 5-year 23%, high returns on invested capital. The company is around 32 times enterprise value to free cash, which is not a price that I would be buying at the moment. But I think I bought around 20, which is pretty good. I think it was a good deal. They have good returns on capital employed, good returns on equity. Their gross margins are really high and they're stable as well. Same with their operating margins. The company is a free cash flow machine with really high free cash flow margins, and they don't have a lot of debt on their balance sheet. Now, the next company in my portfolio is Tencent, which is the biggest gaming company in the world and has WeChat, which is one of the most popular social media app in the world. Similar to Alibaba, Tencent has had some operational problems. I believe at one time the company was trading at around $700 billion in market cap. And as we can see here, they're around 370 billion. Also, the fundamentals of Tencent aren't that impressive either. But what I do believe that Tencent has, and that Meta has as well to some extent, is untapped pricing power. Now, what do I mean by that? Um, Especially for Tencent in their WeChat super app, they aren't really running a lot of ads. Not if you compare them to apps like Instagram and Facebook, where you can really see a lot of ads once you're scrolling through the feed. And I do believe that they're just now tapping into the pricing power that they really have on this huge social media app, WeChat. So I don't believe that my mistake in Tencent was as big as in Alibaba. First of all, my allocation was not as big. And second of all, I do believe that Tencent is a better company fundamentally than Alibaba. It's a stronger company with a brighter future, in my opinion. I did pay too much for the stock, and in hindsight, I can see that. But I was able to average down when their price plummeted. I believe it was last September of 2022. But as we can see now, their free cash flow growth per share is not really strong. But the company is not expensive, trading at only 15 times EV to free cash. The return on invested capital is not really that impressive. They have a decent return on capital employed and a fairly good return on equity. I would say that the gross margins are okay. Same with their operating margins, but we can see that they're going down a little bit for the last 5 years. Moving on to the last company in my portfolio is Meta, which needs no introduction. It is a company that I've held for quite some time. And I was lucky in the sense I was able to get my average price down really low last September, I believe, when the price went below 90, which was just crazy. Um, I did make a mistake in allocating too much money to Meta. The price went quickly from under $90 to over $300, which made them about between 50 and 60% of my portfolio. So I've been selling some Meta just to diversify into other companies. But I do believe that Meta still has some untapped pricing power in WhatsApp and Messenger, possibly Threads. So I think the company has a relatively bright future still, even though that their market cap is now 800 billion. If you do look at the fundamentals of the company, you would like to see stronger growth in free cash. But like we know, they have been investing a lot of their free cash into the metaverse, which is kind of hard for investors to know at this time if it's going to be a good investment or not. But we'll see. The core business is still really strong with Facebook, Instagram, WhatsApp, and Messenger, and it's generating a lot of free cash. So I'm really happy with the core business. What will happen to metaverse and AI and all of that, we'll see. It's hard to tell at the moment. But I would say that Facebook is relatively fairly valued at 33 times enterprise value to free cash. Facebook has always had good returns on invested capital that has been going down for the last couple of years due to their spending on metaverse. So return on capital employed and return on equity is strong for the company. Their gross margins are high and pretty stable, except I think operating margins have been going down a little bit too much, in my opinion. But anyway, that's my portfolio. And like I said, I am going to be digging deeper into each of these companies in the coming videos. This is going to be the format that I'm going to be using for the videos. So let me know in the comments what you think about the new format. If you have any comments about the portfolio. But that's it for the video today. Hope to see you on the next one. Thanks for watching.